the top 10 mistakes that people in their 20s make repeated over and over and over again.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
Okay, this is John Smallwood, certified financial planner from Red Bank, New Jersey, coming live to you on Money Isn't. Well, we're recording live, but we're not live. But anyway, I have an amazing show today that I've been looking to do for a very, very long time. And it's not every day that you get to have, 6 advisors on a conversation to talk about what's going on in long-term wealth planning, right? I've been doing this for soon to be 35 years. In May. Actually, it might be right now. Oh, it is my 35th anniversary in the business. My 34th. My technically 34th, but licensed in the business is 35. What's that?
I don't think you started in 1989, right?
I did. I got licensed in the business and worked my summer in the insurance business, life insurance side, 1989, principal. Awesome. I had some really good stories, by the way, which we'll talk about. Now, so what I've been doing is the build here, the concept is the top 10 mistakes that people in their 20s make repeated over and over and over again. And what we want to talk about today is the impact of making wrong decisions or not making decisions in your 20s that are in alignment with what you want to do. Now, on the call, I have, not in any particular order, okay, I have Rob Marks, Jack Bow, Jared Smallwood, Chris Smallwood, and Jack Smallwood. All of these people on this call are licensed advisors, part of the Smallwood Wealth Management Group. Jared's in this process of becoming licensed, all right, as a junior advisor. Now, when you think about, and I want to frame this before we jump into the conversation, we have 2 University of Delaware graduates. We have a Fordham Gabelli School of Business, a Syracuse Whitman School of Business, and a UPenn grad. There's some pretty smart brain power in this room. And oh, by the way, I was a Bentley College person, all right? Well, I'm not sure how it all ranks up anymore, right? But what we were talking about over the last hour as we were getting ready to prepare for this and previously over some other areas is, what are the things that you hear as an advisor that you see people making these mistakes? And if you could just say to them, if you stop doing this and you started doing this when you're 56 years old, like I am, you'd be a very happy person. Maybe even when you're 30, you'd be a very happy person. So kind of what we did is, what's very, very popular now is the concepts of sports betting. And from the advisors, I want you guys to tell me what you're hearing about sports betting and why you guys think it is potentially a problem.
I think it's less of the sports betting itself and more of the relationship you have with your money and with everything coming in on your phone now. So you get paid direct deposit straight to the banking app on your phone. And you can seamlessly move it to the betting app, and then you can seamlessly spend it. And there's no friction. You got teams of really smart engineers creating these user interfaces and these pipelines for you to spend as much money as you can. And it's really fun. And there's so many different ways you can do it. You see really cool stuff on Instagram. You see really cool bets that your friends are putting. You want to chase their bets and all this stuff. And there's just so many different ways that, your phone, which is this awesome device in your pocket, taking all your attention can kind of derail you and make it really fun to spend. And it's just that lack of any sort of friction is really tough, and you have to just make your own guardrails because there's no regulator, there's no big brother watching out and stopping these companies from trying to, make it as fun as possible to spend a lot of money. It just seems easier now than ever to really accelerate that.
What do you guys see on that?
Yeah, I
It's
mean,
kinda like-
right, there's definitely an instant gratification that goes on with this. People are out with their friends. It's Super Bowl is obviously more common, but just any types of really sports betting on it makes you more engaged with whatever's on TV or streaming from your phone. But the big problem is that the money's in, and then if you lose the bet, it's just out. It's over. And people are just really kind of looking again for that instant gratification from the betting there.
Yeah, I agree. I think a big part of it is kind of crowd mentality. Like, I know I personally have friends that were not very into football or basketball, but when they start gambling with their friends, all of a sudden they're watching every game because now they have money on it. And it's fun, but can you really afford it?
Jared?
Yeah, and the biggest issue is really going to be when people get addicted to it, per se. Like, you go from placing small bets to constantly betting on obscure things, everything you can get your hands on. Even in other countries, they're starting to remove sponsorships of sport teams from gambling companies. So in England and Germany, usually on the front of a soccer jersey, you might see gambling company, and they're actually phasing that out by the end of 2025, I believe, in most countries. So it's kind of going to show that it really is affecting a lot of people. And, those bets are getting in the way of people taking care of their personal finances before their addiction,
Because that's really interesting, because when you guys started to talk about this, what I was thinking about was the circular motion of, I bet on the game and now I have to watch it. So the ratings are going up, right? I'm checking my app to see that score. My focus and my intention is now all towards these things. And then you look at it, the arenas, the sports teams are becoming so much more successful because there's so many more eyeballs interested in the outcome of these games, where before it didn't really matter how many points, you can bet on everything. How many points is so-and-so going to get in the quarter? How many, turnovers will they have? How many, assists will they have? Like, it's crazy the amount of content. But I remember my senior year of college, this would be 1989. And one of the guys, it was Super Bowl, and he was like really trying to get everybody to place bets. I think it was the Broncos. I forget what the 89 was, but it doesn't matter. I think it was a pretty boring game. But it turns out he owed the bookie, which was illegal at the time and shameful, about $40,000 from sports betting in 1989.
Wow.
And now he's working for the
In
bookie.
college.
Yeah, in college. And I was like, how are you ever going to climb out of that? I mean, he had student loans too. So like the impact on his wealth, the opportunity cost. And I'm not saying sports betting is bad, right? But when it conflicts with your financial goals and your financial savings and your acumen and all of, think about everybody that if it's hurting their life, it's hurting their relationships, it's hurting their savings rate, it's hurting that's the problem, because it's easy, right? And there is this attention for the eyeballs. And I think the impact of the opportunity cost, and when I say lost opportunity cost, right, I want to be really, really clear. Anybody want to take that definition and run with it?
What?
Opportunity cost.
Well, no, I was just going to harp on your point really well. First, you said the 1989 game was boring and just crazy. I read here, John Taylor caught his decisive pass from Joe Montana for a game-winning touchdown. This game sounded awesome. So
It was the 1990 game that was boring then.
maybe you were on the Bengals.
Yeah.
No, but I personally don't think sports betting is an issue in that regard. I think the issue is people thinking that they want to wager a small sum to get rich. And you'll see the same thing in cryptos, in stocks, in picking GameStop, AMC, Bed Bath and Beyond. It's if you're not willing to take the long-term play in your 20s and grow your money, why are you going out and you're trying to bet $50 to win $1,000 that you're going to lose continuously? But if you put that $50 per week into the market, who knows? But at the same time, if I'm hitting my 15% savings goal, I'm doing all the right things in my own plan. At the end of the day, we don't tell clients how to go spend money in their free.
Absolutely. If you enjoy it and that's where it is, you can spend the money on what you want to do.
Yeah, like my personal thought is, if I'm hitting my savings goal, I'm paying my premiums, I'm hitting that tax number, paying for my rent or my mortgage, I can go spend it on whatever the hell I want. But that's a whole nother moral question. But I think it's more so of that instant get rich gratification that people see now, because they want to escape their nine to five. They want to have this better life, and they say, oh, well, I know the Knicks are going to win tonight. I know the Rangers are going to win and score 3 goals tonight. No, you don't. But at the same time, you don't know what the stock market's going to bring tomorrow. But there's years and years of historical data that in your 20s, time is usually on your side, and that $1 in the market now is not certainly, but is likely going to be worth a lot more than $1 50 years from now. So that's where I see that's more so the problem that people have, is the instant get rich gratification, that everything you touch should turn to gold, but it doesn't.
Sit number 9 on the list.
Yeah. So this dovetails into the next thing, which is afraid of the market. Okay. And that has been something, when I joined the industry in the early 90s, you came off the 87 correction, which was one of the biggest, 1,000-point drop days as a percentage. It was massive. Okay. And people were really gun shy. And we came off a 17%, 10-year treasury in 1981 or 2. It was 17%. So you got a declining interest rates, and bonds were making a ton of money. So people are like, why do I need the stock market? It's risky. I'll just buy bonds. And it was really hard to get people out of the stock market. And then that shifted into the the late 90s, when you had the dot-com craze. And it was just interesting. But the psychology of, Jack Bail.
Yep.
Why are people afraid of the market?
Simply put, they're afraid to lose money.
Right. And what is that program that's running in their brains? Like, when we're losing money, like, did I pick a single stock and did it go bankrupt? Like, what's going on inside of people's minds?
More so, I know I'm a lot more conservative than a lot of the other guys in the room right now, so I'm probably good to speak on this. But more so, I just think about, I worked hard for my money, and I don't want to see it all go out in one day when a stock tanks or something like that. So there's other options now, such as like high yield savings, but that can only make so much. The market, you need market exposure to really diversify and expose yourself to make more money.
Think on a short time horizon, right? That loss of your capital, of your hard-earned money, it can be scary. But on a longer time horizon, the real risk is not this percent loss that you might have. It's the loss of your purchasing power. If you have $100 today, in 30 years from now, that $100 is going to buy you a lot less. And being in the stock market, having that equity exposure, is a way to kind of maintain, hopefully, that purchasing power going forward, which you can't do with a bond or a fixed income on a long enough time horizon.
Yeah, and also too, a lot of the times when people are afraid of the market, there are, like Jack said, more like risk tolerance where you're a little more conservative. But it's also sometimes people, to John's point of, maybe a single stock or 2 stocks, and what you put into the market is really into the stock of an individual company, and the volatility on these things can be crazy sometimes. And that can scare people, that can scare people a lot, right? But if you if you diversify your portfolio a little bit more, you can kind of stabilize that into what Jack is saying to make sure that you don't lose that purchasing power over, the years that you're working.
Right. I think some people got wrapped up in kind of the momentum stocks of the last 2, 3, 4 years, and that kind of, scares some people away because, like you said, they're so volatile. But that's not the normal way most people invest. You invest in a bunch of different stocks and kind of have a fund versus 1 or 2 companies that now you're exposed to default risk and, a bunch of other different things.
I think less people are actually like there's not as many people who fear the market anymore. I forget where I read this, but up until like 1970s, 1980s, the majority of people's retirement savings was in fixed income. It was less in the equity side. But now you're seeing everybody's like if we go look at any millionaire in this area, there's going to be probably over 60% of their net worth is in some form of stocks, excluding their primary home. So I think that people aren't scared of the market. They're more so lack the knowledge of diversification and what that does in the long run. And because people won't want to pick winning stocks. And if everybody could just pick winning stocks, we wouldn't have jobs.
Yeah.
I think some young people though, I do know some people that are sitting on a large amount of cash and they haven't really, maybe they have a minimum 401k contribution, but they're sitting on this big pile. And it's not that maybe they don't trust the stock market or they're not all about it, but I think there's so many different ways to do it, and they kind of get this they get paralyzed by all the different potentials they could do and picking the wrong one that they don't make a decision. I
think part of that too is the confidence that they have in themselves to go pick the right stuff, like because they're not going to do it right. Like I can go on my phone here and there's 1 billion stocks on Yahoo Finance. All right, I'm going to pick the next Apple. I'm going to pick the next Facebook. I'm going to pick the next Microsoft. People are either over confident in themselves or under confident in themselves. That's where I'm seeing it most is like, oh, what stock should I be buying? What stock should I be buying? What's Reddit telling me to buy?
Yeah.
Chasing. They're like, I want to buy that,
It's the get rich quick thing from the last point.
I was going to say the same
thing. I love it. I love it. It's the same psychology. It's like GameStop, right? Oh my God, I miss GameStop. Oh my God.
So I will be 24 next week. I think I'm probably one of the only 4-year-olds there is that truly says, I love my job. I love what I do. I think most people get up, go to work, aren't necessarily happy with it. And they're seeing this as a bet. It's the same thing as if I make enough money and I get lucky, I won't need to come to this job anymore. And I can go play 18 holes every damn day for the rest of my life and destroy my back.
Yeah. And Chris, just to hit on something you said too, with where you said the 60% side of, someone's assets outside their primary residence being in equities. That's another thing that causes a lot of market fear too, because people think if they have, a certain amount in their bank account, they look and say, oh, I couldn't take that, with a market swing. But, it's not, ideal to put every cent you have into the market, just like it's also not ideal to have every cent out of it. I mean, we've even seen people, where they're so risk averse to the market, they've actually increased the risk in their planned success because they're so afraid to, have any sort of equity exposure. And, inflation kills you year in and year out. It eventually gets to your planned success.
What's really interesting to me
when you're young, like time is on your side where you're able to make mistakes. Like you're not able to make a mistake in your plan when you're 55 trying to retire at 65. But when I'm 25 trying to retire at 65, there's margin for error, even though we don't want error.
Mm-hmm.
Yeah, but errors are part of the plan. And like if you think about it, I'm right on my little side thing here is this where there's a 100-year-old coin chocolate for a 100-year-old birthday party that I attended about 2-3 weeks
old
ago.
chocolate.
Right.
I
And
wouldn't
it's
eat it.
everybody, not everybody, but most people that are listening to this that are in their 20s, 30s, and 40s and 50s have a high probability of living beyond 100. Quite frankly, far beyond it. Okay. And the market over long extended periods of time proves to be the winner in the long run. Starting a company proves to be the biggest one because everybody on the Forbes 400 list, the billionaires, nobody got there by Buffett maybe.
What about Bezos' ex-wife? Come on.
Well, you either inherit
She's on it, right?
or you get a really good divorce, right? And there's a lot of people on that list that have inherited money, right? There's a whole other conversation that we're going to discuss, not today. Yeah. And it's so like the biggest thing that I see for people coming into the business now, right, is, and I don't say business, I don't see the advisors, but clients coming into us. They come into us, they're 15 years out from retirement, they're 10 years, or they're referring our kids in because they want to, like, if I had only started this when I was my kid's age, where would I be today? Right. And they come in and we start asking about their corporate benefits. Let's say you work for a corporation that you don't own the corporation for a second. If you own the corporation, this also applies, right? Because you have control over what your benefits are going to be. Okay. But like, how many people have you guys encountered in the last 2.5 years that you've been here as advisors, 3 years for some of you, that understood exactly what they had for corporate benefits? And what am I talking about?
Not many. Not many.
What am I
It
talking
seems like
about?
most people understand the basics, 401k match and stuff like that. But when you try digging in and asking more details about their disability benefits, any life insurance offered, most people really don't know much. And that's where we kind of come in and help them understand.
Even on the health insurance, which a lot of people are focused on, there's a lot of just kind of signing up for the first one that's offered and not digging into the plan. Most of the plans I've looked at, have some sort of high deductible offering. And a lot of times if you look at the amount you save per month, because you contribute to whatever health plan you're on a little bit, the difference in the premium per month, and then usually you get some form of a kickback to your HSA account from your employer. You do better by picking that almost every year. And then, as long as you don't hit your maximum deductible every single year, then that's going to be a better option. So really, if you're single and you have a low risk and, you don't have a child and you don't have those huge expenses, like most years, like something like that is going to be better. But you really got to look every year at all your offerings and kind of do that math out a little bit.
There's stock purchase plans, there's, 401k matches, there's a whole bunch of stuff that just gets missed. I mean, people come in, they don't have wills.
Expenses too, like getting a travel stipend on a pre-tax basis. I've seen clients come in and say, hang on, what's that? And I'm like, you're taking the train to the city every day and you're not taking the travel stipend that they're willing to give you because it was in the fine print. It's the little stuff, or paying for your gym membership, even paying for your wellness fund. Like, there's companies out there like are giving more than they've ever given because it's so competitive to find workers. You need somebody that's going to be a dedicated partner to you and go through your benefits for you, which is us.
I mean, it is. And like, how many people come in and they're like, I don't know what I have.
Tony, flip it.
And then when did they make that decision? When the open enrollment's going on, and it's like, I gotta make a decision by Friday. Why? Rob, you were saying something.
Oh, yeah, I was just going to say, like, a great point on this side would be how many people truly take a look at their pay stub and know what deductions are coming out, what employer benefits are, and more importantly, is that the fit for you? How many times do we see someone where they have a biweekly paycheck and it's, minus $15 a paycheck for, it says, credential, whatever. Like, people aren't, always aware of what they have in there. So if you don't even know what's in there on that pay stub, how do you even know if it's right for you? And to Chris's point, that's where, we can come in and really dig in, as John has seen, all of us do, really dig into that fine print and see, is this coverage all that, it needs to be for your plan?
right? And there's like leaks. Like when we look at this, to me, there's financial leaks that happen all over the place. Like I have benefits, I have to contribute to the benefits, and I'm buying in and I'm doing it. And just because it's available to me and it's easy, group term insurance above the excess seems like a no-brainer, right? Because it's just easy. And when you look at the cost per thousand compared to buying it on the open market, it could be twice as much, depending on your age. And it's going up every 5 years, and you miss the opportunity to lock in. And the transfer of wealth is massive. Like if you go in and you look at the corporate benefits and you say, I want to maximize it, which means I want to reduce the cost, max the benefits, and get as much value in an HSA, a 401k match, and all these different places, and you recapture some money and move it to the other side of your plan, what's that worth 20 years from now? And as an advisor, if you can really understand how the benefits work at XYZ company, most people don't have anybody, they don't have an advocate, they don't have somebody that really cares about what their benefits are. It's like, oh, you should do everything over here with us. No, that's the furthest thing that you should do. You should maximize what you have available corporate. And I know that, think about how many jobs that you're going to have in your career for the average person. It's not going to be one and done. You work for the company for 40 years and then you get your golden watch and you retire.
It used to be.
It used to be that way. It's not going to be that way for most people. I mean, even though I've been self-employed for 34 years. How many companies have I been with?
More than I could probably wrap my head
More than
around.
I could probably
I
wrap my
actually
head.
tried to follow that train, and it's a very difficult study.
No, and I think it's, this doves into, corporate benefit maximization is really, really important. And if you're an entrepreneur and you have your own company and you're trying to attract and retain and keep employees and you're trying to protect yourself, the corporate dollars sometimes can be the cheapest way to get the benefits that you really want if you really understand what it is. But you got to really understand when you're building the wealth plan, as an entrepreneur, you own the company. Every dollar that you don't take out of the company is a dollar you don't take out of the company, right? That has an impact, right? But I got to maximize every dollar. And there's more opportunity as a business owner than there is as a corporate executive because you control, right? Let's talk about 401k versus 401 Roth. How many people have you spoken to in the last 24 to 36 months that don't know if they have a 401 Roth, and they have a preconceived notion that they don't qualify for a 401k Roth because they make too much money? How many?
Well,
come on.
There's definitely that too, and then I also think to like, I don't want to take away from that point, sort of, but there's also I'm putting in 10% into my 401k. That is enough for my entire savings, and it's like, well, what do you think your qualified money is? And it's a lack of understanding the qualified money versus the Roth money versus the non-qualified money, which I think a lot of people get themselves into that hole.
Let's define what 401k versus 401 Roth is for a second, for all those people that don't know.
Can we get that from our CFP on the call, Mr. Robert Marks?
Oh,
yeah.
thank you, Chris. Look at that warm up. All right. So, right. So basically you'll have two options in your plan when you have a 401k. You can make what's called a traditional 401k contribution, which is pre-tax money. So it's coming just right out of the paycheck and goes right into the plan. Or you could do what's called a Roth 401k contribution, which basically means that money is taxed first before it goes in. Where it comes into the strategy side of this is that for a regular 401k contribution, as most people would call it, it goes in pre-tax, and then when it's in the 401k, it's tax deferred. So everyone's thinking this is great. I don't have, I didn't have to pay any taxes on this. It's going to just keep growing my wealth. But the problem is that, when you go to take it out of your 401k after your retirement party, it's time to pay the piper, which is, the U.S. government, right? And
Robert,
that just cripples the expectation.
Do you think you'll be in a higher tax bracket when you're 60 or right now?
Exactly. When you're in retirement age, you've done,
Sure,
you've
hoping
done
I'm
You'll be
most of
60.
making more
yourself
money,
there.
right? You'll
Right, you've
hopefully
done-
be making more money and have a higher tax bracket.
And what will
Yeah,
tax
and
rates
people
even
don't-
be then by the time you're taking the money out for a distribution?
Yeah.
And
Yeah, and
here's the
you know,
powerful
people don't
thing,
really
like,
think about that. Like the tax bracket that you're in today is, possibly, hopefully that's the lowest bracket you're ever going to be in. And people completely miss out on the Roth 401k contribution here to get that tax paid out today and take that tax planning out of the variability of your plan when it comes to retirement.
And I challenge anybody who's listening to this, if anybody is, go look up what the historical top tax bracket rate in the United States of America is. That usually makes people shit their pants.
which was
Yep.
what? Which was what?
I believe in like 1950. I think it was like the 60s, really. Late 50s, early 60s. I believe we were up to 88, maybe low 90.
It was
which-
90.
Could you imagine that?
90%. Jack Nicklaus, first year on the golf tour. They were interviewing him in Golf Digest in 1994, and they said, "How is Clintonomics going to affect you? It's this 39.6% tax bracket." And he said, "Well, my first year on the tour, I made 100K and paid 90,000 in taxes.
Yeah,
so how bad is
that's-
Clintonomics going to be?"
You'd be shocked how many people do not know that. That was
Yeah, fact check this on
anything.
that. And I have a really good YouTube video up on
That's
this.
back when the U.S. was its strongest, right? And now we're the weak U.S. According to the youth.
That's
do
what
you
we were
think
saying
taxes
before
will
too,
go
right?
up? Do you
That,
think taxes will go up? Definitely.
and we were saying before too, right? Like you're in the stock market for the long haul, right? You're 25, you're 24, you're 26, and you're this money away for retirement when you're 60, 65, 70. What's that dollar you put in today going to be worth when you're 65, when you're 70? And like, so you got to think about that as well. Like you're letting that fly in the Roth option.
I think
And
that
we're
hits
saying
home
too-
pretty.
yeah.
I think that really hits home with people our age too, because even within our lifetimes of the last 20 years, you've really seen purchasing power decrease in the last couple of years. So I think that's definitely on
like,
people's minds.
Biggest thing too, like what's the biggest expense of your entire life? It's paying
Retirement.
the government.
Government.
Like I luckily had to write a nice check to the IRS this year, and that sucked. And I literally said to myself was, I don't want to write these things. I want to have the most tax efficient plan going forward. So when I'm withdrawing, I don't have to like actually break my hand when I got to pay Uncle Sam.
Yeah. Yeah. Rob, you were talking about corporations and, participating in the 401k and getting the 401 Roth, right? A lot of plans that we're discovering now have the ability to do what we call a mega backdoor Roth, right? You can make an after-tax contribution to the plan depending upon the makeup of your company and then convert it to Roth inside the plan. And you can put away a combination between the match profit sharing plan and your contribution up to about 63,000 this year.
There's some plans that'll do it automatically for you too. You can set
Yeah.
it up.
And then people don't even know what it is. And it's like, you are leaving, like, I'm hoping everybody listening to this that's in their 30s, their 20s, 30s, and 40s is in the lowest tax bracket that you'll ever be in your entire life. To not take advantage of Roth to the extent that you can take advantage of Roth, which is if you work for a company and you have a 401 Roth, it's the same max contribution as the 401k. And you can split both. You can go, hey, I want to put half my contribution in K and half my contribution in Roth, right? But if I make over a certain amount of money and individually, I can't do a Roth, but I can make an after-tax IRA contribution and convert that to Roth on the same day or some other point in time. There's a whole bunch of technical things that can be done. But when we think about planning, nobody knows where tax rates are going. We don't. Why? Is it better to have balance or to have everything in one place, Jared? Does that make sense?
Balance is always the key, because if one thing
Especially
doesn't go well.
Especially if you read chapter 6 of It's Your Wealth, Keep It, and the Beautiful Balance.
Yeah, you're pointing to it, but we don't see it. Okay. But now I want to jump
Amazon
into,
bestseller.
yeah, I want to talk about, thank you. I want to talk about number 6 in this concept, right?
Yeah, let's start.
About
flying.
liability, insurance protection, maximum protection. And we find a lot of people talking about, oh, do you have car insurance? Like, yeah, I got car insurance. It's cheap. It's fine. And what are we finding the majority of the time? And it's been the same for 34 years.
People are focused on just getting the minimum. They want the cheapest. They want the cheapest auto, the cheapest home. People don't have an umbrella policy, and it's very cheap in the moment and very expensive when something bad happens.
I think that goes hand in hand with one of my life rules is this is truly a world where you pay for what you get. If I'm buying a $10 pair of shoes, I'm going to get a pair of shoes that's worth $10. If I go up and I get the $25 pair of shoes, typically it's going to be made with another degree of quality. I think the same approach could sort of be used in all types of financial choices. If I'm buying the base bare bones policy, when the shit hits the fan, I'm not going to have the right protection. I'm not going to have the right team on my side. I'm not going to have the right coverage. But if I just pay a little bit more when the bad things happen, because bad things do happen, I'll have a much better plan and I'll feel better and I'll be able to sleep at night. Where, oh, if I just spent $30 more per year and I added on more liability, I would be totally fine right now. But I wanted to save $25 over the course of a
And what's
year.
interesting is, what's really interesting is, I have 2 questions. Where do you shop to find $25 shoes?
I was thinking the same
No,
thing.
Yeah.
Okay. But there's this mindset that is what the insurance company really has in mind for us. And I'm talking about car insurance, homeowners insurance, etc. Right? You know, RV. How many people own jet skis and are not even insured because there's not a requirement, right? It's like, oh my God.
Most.
But it's like the insurance company says, we'll give you a $250 deductible. And you're like, oh, I can afford that. If I have a problem, that's fine. But then they lower the liability limits to like 50K. And the risk is not the deductible of 250. If I raise that deductible up to $1,000 and raise my liability up to 500,000, I'm paying the same or less premium. You know, the insurance company's mission, and this is not disparaging on any insurance company because they're necessary things in life, and they're, you know, Chris, you said bad stuff happens. It does. You don't know who it's going to happen to, but when you're insured, it's not bad because you're insured. The outcome is protected, and there's no way you can self-insure anything. Okay, it's impossible. Okay, regardless, and we'll talk about that in another thing. But like, if I'm going to pay the same amount of premium and get 10x more coverage for the same premium, that's a smart decision. All right. And that's what we want to focus on is, how do you build a barrier? Let's just say that I had $50,000 worth of car insurance liability coverage when I was 25, and I did. Okay. But let's just say that I actually did. And I got in a car accident and I got sued for $1 million and lost. Where's the 950 going to come from? It's worse than my gambling scenario. You're literally gambling.
Worse than your worst stock market nightmares. Yeah.
Yeah, I mean, it is
Instantly erode your plan.
And there's no way to get around it. Bankruptcy is not you can't go bankrupt to get out of that, by the way.
Yeah, and John, just adding on to what you just said, people work so hard to be able to build up these assets and, make sure that it's the most that it can be. And yet, sometimes they won't pay the premium to protect it in the event of, no matter how small the chances are of something like that happening, they won't pay a little bit of premium to make sure to maximize the protection on all those things they work so hard to get.
Right. But they'll spend $1,000 out at a bottle bar on a Saturday
Even
night.
even on a much smaller scale, like one home insurance additional coverage I like to tell everybody buying a home to get is to get the service line extension rider on your home policy. So if your main sewer line or your water line or your utility line from the street to your house breaks, which they do, both buildings that we're in right now have had problems with the main. And you got to trench it out. You got to trench to the street, pull up your pavement, pull up your sidewalks, pull up your walkways. It's really expensive, really quick. And it's about, I mean, ballpark about $20 to $40 a year in coverage for that. And it's, something that happens way more often than people think. And if you call in to your property and casualty guy, then just say I want home insurance, they really don't offer it up all that much. You usually have to ask for it. And it's one of those little protections that you can add on to your coverage to really make sure that you're set and you're covered.
This guy
So
owns a
important.
home. That guy
Yeah.
has a mortgage coming straight from
I've had- I've had some problems.
and for all my renters insurance.
Yeah. So, the same thing spills into, life insurance, right? Life insurance and disability insurance, I think is, for people in their 20s, is one of the hardest things for them to really grasp. Like, why do I need it? I'm not married.
Well, John, yeah, let me ask you, right? I'm 24, not married, no kids in the picture, no nothing. If I were to die yesterday, now we know it's not true. Why would I want my siblings to get rich with the death benefit? Why? Right? Like,
Yeah, but that's an unfortunate circumstance that you would have died yesterday, and now we know it's not.
I would have
It's
missed
not
the
true.
next game. Yeah.
Yeah, but like, what's going on for the rest of your timeline, right? You're 24 next week. How far are you going? 100, 120, 130, 150? What's your timeline? And think about all the events that are going to happen yesterday, tomorrow, the next year, the colleges, the births, the buying of the cars, the business liabilities, all the things that you're going to have that are wonderful, that require some level of protection, that are going to be more expensive and potentially not purchasable in the future. I think what people don't understand is like, there's term insurance, there's whole life insurance, there's universal life, and then there's hybrids of all of those different products, right? But like, life insurance in people's minds are dollars delivered in the future when I'm not here. So why do I give a shit? That's not what it is. You got to talk about what it is, right? If I really understood what permanent, potentially whole life insurance is, right? If I came to you and I said, we're going to put money into something that's going to grow tax deferred forever, and that I can generate tax-free distributions of it, and it makes a competitive rate of return, and it has strong guarantees. And if I became disabled yesterday, the plan continues. And in most states, the cash value is protected from creditors if I'm sued, where my bank account is and other things are not, right? And when I pass away, there's a large tax-free benefit that cleans up all my messes. And oh, by the way, and this is where I think people really miss the picture, is that it's sort of like I can invest my money elsewhere and make a higher rate of return. And what's really interesting is when you blend multiple products together, life insurance with an S&P 500 strategy, life insurance with a 401k, life insurance with a real estate plan, life insurance with a business, the two together actually reduce taxes, reduce risk, reduce fees and costs, increase savings rate, and provide higher levels of protection and actually achieve a better outcome.
And John, just to harp on that more, is how many whole life policies do you think you've sold in your career?
1,000? 900?
Of that
1,000?
1,000 or so cases that you sold, how many of them, once they truly understand, it's like, oh, damn, I wish I started this when I was just a little bit younger.
If I'd only, I had a conversation with somebody yesterday.
Yeah,
And
I personally think that's the biggest thing is once you understand permanent insurance and the benefits of it, it's always should have started this when I was 20.
well, I started one when I was 22 years old. That product happens to be one of the best things that I've ever done, period, because of the consistency of where it is. But what's powerful is if I had money in a 401k plan, if I had money in the stock market, if I had money in a piece of real estate, I don't have access to that money in full form. So most people are maxing out their 401k plan. They don't have any liquidity. And then they have the sewer problem that we talked about that wasn't properly insured, or they have an opportunity to buy something and they got to take a 401k loan and they're limited in what they can take out and they're limited to what they can put into it, right? And now all of a sudden, well, if I do that, it causes credit card debt. And I'm telling you, if you don't understand the role of your money in the long run and having access to money along the way, like the two guys that are on this call, one with the beard and the older guy, okay, the Smallwood brothers, the older two, I bought a whole life policy when Jared was born, specifically for college, specifically. I never used that policy for college. I used that money in that policy to buy office buildings, to do other things along the way, which kept making more money because I had access to the money and I got great tax benefits. I got great opportunity on this thing, right? The most important asset in the room, not this room, but your individual room, is your ability to get up every day and go to work. It's your ability to be insurable. Once you're uninsurable, you're uninsurable. And you can't self-insure, right? And I say this to be very, very, let's say I owned a house and it was $1 million and I got it paid for. I technically don't have to insure it anymore, right? Because I don't have a mortgage. Let's say I have $1 million in the bank. Let's say I have $1 million in the bank and I have $1 million house. I'm feeling pretty rich, right? And I want to get rid of my $3,000 a year insurance premium to cover that house. And then the house burns to the ground. I do have the $1 million in the bank to go rebuild the structure, right? But as soon as I do that, now I only have $1 million house. I've taken all my cash to put it back in the house. My net worth went from 2 million to 1 million the next day. If I'm a building and I'm producing $100,000 a year in recurring cash flow as my building, I'm a building. Okay, think of myself as a building for a second. How much would you insure the building for, Jared?
The entire value plus the income.
Yeah, the entire value. You want to be able to rebuild the building to get the same income, right? So I would need a lot, what would it cost to rebuild that building? Well, if I use 5%, as the concept, I need $2 million in the bank to replicate the $100,000 at 5%, right? So the economic value of that is $2 million. But if interest rates were like, 10% in 1990, I only need $1 million. I just destroy. You have to be so freaking careful of when you make your decisions, because you make decisions in the moment as if they're going to replicate into the future. And guess what? They don't. So there's the insurance companies look back and they go, male, 25, earning $100,000 per year. Insurability is 3 million maximum.
No, I think it's actually 35 times, right?
Oh, you're right.
In that age bracket,
You're right.
I believe.
Yeah,
so.
under 35, generally 35
Come
pounds.
on.
That's why you guys are here, to help me.
Well, and John
Can't
too,
forever.
like, a lot of the times, I know we were talking about the corporate benefits before, and how many times have, we all seen, especially, from how many meetings you've had over the years, of someone saying, oh, I have group benefits, yeah, it's one-time salary on life insurance. And all you have to ask someone when they say that I have one-time salary is my death benefit and that's fine, is great. Your family's covered for a year with your income replacement. What happens in year 2? And it's never a good answer because they didn't maximize the amount of life insurance coverage they could have to make sure that, you know, if that happened yesterday, that their family's taken care of for all that income replacement.
My
And the
wife's
same goes on the
attracted, she'll
disability
get
side as well.
remarried. All these things that you hear. But here's the thing, like when you have really good quality, I'm not saying you should buy all whole life, right? Because if you did, that means you're putting all of your money into the same basket to get to the whole thing, right? Chris, you said, oh, I died yesterday, right? Let's pretend for a moment that I died yesterday. Okay. Does it matter the type of insurance that I owned?
No.
No, it just mattered that whoever is the agent is walking in with the proper check to keep my dreams alive, everything that I want to get done. And that policy should have certain elements to it that make it successful. I see all these cheap online policies that are really, they're okay. They might be 10, 15% cheaper, but they don't have conversion options that are extended beyond 5 or 6 years. And if they did, the policies are giant, crappy policies to convert to. They don't have any quality. They don't have the waiver of premium benefits that are worthwhile. They don't have the benefits and the protection. To have proper planning is the most important thing. Now, disability insurance, people don't take advantage of the disability coverage that's offered to them. Sometimes you'll get 50%, or sometimes you got to opt in. Sometimes you're self-employed and you got to buy it. And it's like, oh, I don't want to buy it. Or I go to work for a company, a startup, and they don't have any benefits. Well, I don't have any benefits. That means I can't protect myself.
Well, what did you just say before? What's the most important part of your plan if you're young? It's your ability to get up in the morning and earn money. And why would you not want to insure that?
Yeah. If I was disabled yesterday,
even
and I'm
with
thinking about this, go ahead, Rob.
Oh, I say even with the group disability, when we were referencing earlier about really pouring into the details, how many people, they say, oh, it's 50% coverage or 60% coverage, having no idea that, the benefit was paid by the company and now it's a taxable benefit, or it's something like it's 50%, but it only covers salary. And oh, by the way, most of your comp is actually commission and now there's no coverage there. It's just a misunderstanding of how underprotected someone might actually be on that disability front.
And also in group disability, a lot of the time they include clauses that most people don't realize that, coverage may drop if you meet this criteria, or it's a lot stricter than if you buy your own policy on the outside.
Yeah, it's typically any occupation 2 years into it. It might be own occupation, which means that the job I'm doing right now today for the next 2 years, and then it's any occupation. Well, that means I was a trader making $150,000 a year on a research desk trying to get to 350, and I become disabled. In 2 years from now, well, you can go to work in the mailroom. Oh, is that what you want?
What's that terrible stat? It's what? We got 6 people on this call. I think it's 1 in 4 by retirement are disabled.
Yeah, 6 months or more. And the devastation of their plan is disability.org. It's crazy. It's crazy. So let's talk about creating a plan. Okay, let's jump into not starting in your 20s. Like, I really feel this, like the last 4 things that we had are waiting to start a plan to when you have money, right? Not investing in your 20s, paying yourself first, in true goal setting. These last 4 things all dovetail into a beautiful strategy, and they're all connected, right? If I'm waiting to the future when I have money, that means I'm never going to have money. Why?
I'll make a fitness plan when I'm ripped.
I'll eat broccoli when I'm ripped.
Is that why you're a rip, Jack?
Yeah.
Yeah, and people, to that point, like people think, oh, when I have this amount, then I'll go talk to someone, then I'll do this and that. And they're not realizing their plan's already started. It's just, when are you going to take the time to really commit to, okay, these are the goals that I'm going to set out for my own plan? And
part of that starts with people say, well, how do you have the money and the cash flow to invest? Like, I'm so tight on it. It's back to that concept of paying yourself first, which is part of your own plan. Is when you get paid, you need to move that money to the right spots where it needs to be going for your savings, or else it's going to be gobbled up by lifestyle. I'm guilty of it. That's why I'm the biggest pay yourself first. Anytime I ever get paid, the check gets chopped up and sent to wherever it goes, because I'll say, oh, I got money to spend now. I got money to spend. That's my lifestyle money. And my lifestyle money is I can do whatever the hell I want with it.
I can't tell you how many friends I have where their savings plan is kind of money comes in and they don't really have a set savings plan on a monthly basis. It's just they have excess in the checking account. Oh, I'll send 1,000 or 2,000 over to savings now, but it's kind of as it comes in and as expenses take it away. It's not really a set plan. And that's a lot of my friends that kind of save on that basis.
Yeah, almost anywhere you work now, you can go to HR and whoever does your payroll and say, I want to send 10% here, 10% here, $500 here, every paycheck, and just let it go. Like, set up those guardrails for yourself and pay yourself first. Never been easier.
And that's one of like the bigger things too, is like everybody says, well, I'm saving to my 401k. That is enough. Everybody else in this country is saving their 401k. Do you feel good having the exact same retirement plan as everybody else? Or do you want to be doing something a little bit more, a little bit better, and a little bit sharper? Because I sure as hell don't want to be doing the same thing as the rest of the US, because most people, I believe there's a stat out there, right? How many people can actually retire on the same lifestyle income?
Yeah, out of 100 people that enter the workforce in their 20s, how many people retire wealthy?
Not many. It's not.
It's less than 1%. Less than 1%.
So why are you falling into that same cycle by not having the plan and just relying on your qualified 401k?
Because I don't have the knowledge. I don't have the time.
You have the time. You have 40 years to get the time and the knowledge on your side and start preparing for that. Because if I'm not preparing today, I'm never going to be ready for it.
You know,
You're going to be somewhere in 40 years.
Could be somewhere great.
Yeah.
Could be. Only you can decide.
Everybody's following a plan, but whose plan are you following? That's another Jim Rohn that we were just talking about, that Jack, you just did, right?
I also think there's a Mike Tyson quote. Everybody's got a plan until they get punched in the face. And sometimes
you're literally getting punched in the face when you have a shitty plan.
And sometimes the market's going to punch you in the face.
Everybody sees this all over the internet. If I invested from 20 to 30 versus the guy who starts at 30, that person invests 3x and has less money at 65. The problem with the 65 number, okay, is that when Social Security arbitrarily was invented and said, we're going to give you a retirement benefit at 65, the average life expectancy of a person at that time, back in the 20s or 30s, whenever it was 40s, whenever it was created, I don't know the exact date, but the average age was 65. So they weren't planning to pay anybody out. Okay. Now the average age is pushing 80. It's like 77. It was not meant to be your sole retirement plan, nor was the 401k. So like, I think there's a whole problem. And if I could go back and insert myself into the 22-year-old John, and I did a lot of savings, I've invested in my business, and I've done a lot of things, right? But if I can go back and insert myself back into my 20s, the one thing that I would have done, which I did, but I would have done it differently because hindsight, age, grayness in the hair, which I don't really have, but I would have got a lot clearer on what my goals really were. Somehow I felt like goals were like, oh, future-based things that everybody's got goals. But what I realized, let's say that I'm 22 years old and I'm working for a company and I see a better way to do it. What if I jump out and build my own company? But I would, like, what would my future be with really strong goals? Let's say I'm really happy working for a corporation. I'm loving this thing, but I want to be worth $500,000 when I'm 30. How am I going to get there? What do I have to do with my plan? You know, does the company I work for have stock options? Does it have a stock purchase plan? Does it have, am I going to go to work for a startup? Am I going to go to work for, not all startups end in millions, right? Some of them end up in pennies, right?
I'd say a large percentage.
A large percentage, like anything. But like, how am I going to orchestrate my wealth and what am I going to do to get there? Like if I work for a corporation that doesn't have stock options and doesn't have these things, but I can make more and more money, what people fail to do when they're making more money is to actually put away a greater and greater percentage of their wealth. Like a lot of people come in, well, I'm putting in 10% of my money into the 401k plan. Well, you're making $500,000 a year and you're capped out at 22,000 or 24,000, whatever the max is for this calendar year. Where's the other money going? People don't really strategically save.
I also think too, like there's people that shy away from making plans because they say, oh, it's going to tap into my lifestyle. I'm not going to be able to fully and enjoy it. And I want to spend and enjoy my 20s because my body's good, my health's good, and I can travel. I don't have kids yet. And I'm all for that. I think everybody should be doing that, but at the same time, there's a balance to it, and you have to, if you're not taking the strides now to plan for it, that you're never gonna get to where you want to go, and you're able. Like I think like lifestyle is a great thing. Like I want people to enjoy their money. It's like, why do you work hard? Not just to watch the balance go up. It's to watch the balance go up and also at the same time enjoy my life, because we don't know when we're gonna die. We don't know when things end for us. It's, yes, I need to be making that plan. That plan lets me go live. It lets me travel. It lets me go to the Yankees games on the weekends. It lets me do all the things I want to do. I know, and I feel great when I wake up. It says, all right, I'm on the right course. This is fine. I'm able to do this because I'm still paying myself first.
Yeah, and Chris, that's actually that's a great point, because listen, you want to have that savings rate to be able to get up, be financially secure, but you also don't want to have so much in the savings that you don't get to enjoy today. I mean, we always go back to, they have the 100-man story from the Social Security Administration, that basically if you took people from, I believe it's early 20s or age 25 until about age 65, out of 100 people on average, you have 54 that are relying solely on Social Security for income, 36 have passed away. You have 5 that are basically working a job in retirement to get by. You have 4 that are financially, independent and can kind of maintain their lifestyle. And you have only 1 person out of the 100 that are truly considered wealthy. So really you have to take that back to say, kind of like John was saying, if you went back in time to age 25, what are you doing in today's plan to make sure you have the best chance of being that 1 out of the 100 in that story, while still, to Chris's point, enjoying some of your lifestyle for today?
I want to just say something for a second. You actually get to design your entire life, right? And we're talking about investing today in different products and different vehicles, but perhaps the investment is not in a product. It's not in a vehicle. It's actually investing in yourself, right? And like, I see this happening frequently. And I see teachers come in, right? And they've been teaching for 10, 15 years, and they're 2 credits shy of a master's degree. And I say to them, do you realize if you went up, there's a band, and the pay based on master's degree is higher than that with not. And if you spent the $3,000 on the master's degree online, you'd make $8,000 more per year. And that means your pension would be higher and your savings would be higher. And they're not like, that's so small in my thinking, right? It's a small ripple, but it's huge in their lifetime. Okay.
Yeah. And sorry.
The investments you make in yourself, I'd rather not have somebody invest in the market, but rather invest in themselves, become the best version of themselves, because they're going to go from a menial or a mediocre job, or, stuck in that train where everybody's like, oh, I hate my job. It's Monday. Oh, happy hump day. Happy, it's Wednesday, and I'm going to go Friday and I'm off. if you can invest in yourself and be in something that you love doing, 10 years from now, how much more money are you making? The problem in finances, financial planning, and this is where I'm going to end, and I want you guys to keep going, or I'm going to end saying stuff, is everybody believes that financial planning is a linear transaction. I put away $1, it compounds at 12%, and miracle of compound interest is going to give me a ton of money. It's not. It's non-linear. It's exponential. And the things that you do when you invest in business, to get a master's degree, to bet on a business, to bet on a training course, to improve your mindset, to become the physical fitness person that you want to be in your best shape, your mind changes. And it's the possibility of what your future can hold, that's what we want to invest in. I mean,
and that's when
where's the money
too, is like, all right, I don't want to spend $75 per month on a gym membership. That's too much money. That's gonna kill me. What's gonna kill you is when you got to pay $1,000 more in insurance premiums because you're not rated high enough for it. Which, granted, that's not always going to be something that you go to the gym for. But how could I truly say I'm taking care of my family if I am not in the best possible shape and investing in myself? And that's going to save you money in the long run. That's one of your best health and insurance plans, is taking care of yourself. You always say, I'm $1 million racehorse. I wouldn't feed it the garbage wings that I ate last night.
Yeah, what was the horse that won on Saturday?
Mystic Dan.
Yeah.
What is it?
Mystic Dan.
Did you understand what he was fed?
Yeah. He was not fed McDonald's, and he did not sit on his couch this weekend watching reruns of Friends.
He didn't have a bunch of beers on Friday night before the race either.
Yeah, maybe Wade Boggs' horse.
So, as we wrap this up for a second, what is the one piece of advice that each of you has for somebody that's in your shoes, starting out in a new career? What's the one thing that you could tell them that would change their entire future?
I would tell them to pick up their phones, dial 732-542-1565, and ask for Chris.
Awesome. Jack, what's yours?
Yeah, I think it's just, we were talking before, like, you really got to believe in yourself and make that plan. Like, as Jim Rohn always says, you're gonna end up somewhere, whether it's intentional or not. So you gotta kind of set those goals and make that plan, and everything kind of falls into place under that. But you have to be intentional about it.
Love it. Rob?
Yeah, I would say number one piece of advice is just get started. You know, everyone, to our point earlier, everyone is already in the midst of their own financial plan. Just get started at looking at, you know, what you have, what you should have, and then figure out, you know, how can I bridge that gap to get to where I need to be the most successful that I can.
Jack?
I would say kind of similar to Rob, obviously get started. The longer you wait, the longer you're handicapping yourself, but also make sure that you dig into your employer benefits and make sure you're maximizing what's already offered to you and utilize all those benefits.
I like it. Jared?
Yeah, also building off of Rob, best time to start was yesterday, best time to start is now. And that the plan doesn't fit the same for everybody, right? You know, you got to think about this dollar that I'm spending on, you know, investing versus insurance versus, you know, maybe educating yourself or something like that. Does that give me the best return in the long run? You know, putting all your money into one place is never going to be the best solution. But, you know, a master's degree fits for one person, but not the next, and kind of making those decisions. You know, sometimes
Yeah, a lot of people get a
more
master's.
about the journey rather than the destination, you know?
Yeah. And so what I'm hearing is invest in yourself, pay yourself first, call Chris. Just joking. But I think the most important thing is, if I'm going to sit here and I'm going to do this for as long as I humanly possibly can, because this is what I love doing, and I love getting people to really make really smart decisions about their financial future. Working with an advisor should actually add value, meaning the cost of an advisor, the cost of a financial plan technically has no cost, because a really good advisory team is going to find all the waste and the leaks and the crap and the mish stuff that's going on in your plan and help you get to a higher level, because that's what we do. You do what you do, let us do what we do, which is help you get to the next level. All right. So this is awesome. This is a great conversation. If you're listening to this and
God
you
bless you.
want more information, you can go to the website smallwoodwealth.com. You can get those things, right? You can get that going. Yeah. Not working on your Zoom effects for some reason. But you can call 800-797-1000. You can listen to Money Isn't podcast. You can subscribe to this. You can download a copy or get a free copy of It's Your Wealth, Keep It by setting up a wealth curve conversation. I believe the best thing, the smartest thing that somebody can do is to sign up for a free, no obligation wealth curve conversation. It's a 40-minute conversation about you, what you want to achieve, what you're trying, where you think your obstacles are, and determining whether or not we can help you. And if we can't help you, we're going to get you to somebody that can help you. But 9 times out of 10, we can. And most people that jump in, as somebody said a couple of times on this call, is they wish they did this long ago. They'd be in a better spot. This is awesome, guys. And if you have any ideas or questions, send us a message. Love to get the feedback.